Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park. She's the editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Welcome back to the show, Danielle.
Thank you, Jim.
You talk about the Warren Buffett effect. What exactly is that, and what does it mean?
Well, it's interesting because May the 5th was the annual meeting of the Berkshire Hathaway shareholders meeting, and every year that's quite a show, literally, with the media scrum descending and, everyone looking for bullish commentary from Warren Buffett. And I always think, the thing about Warren Buffett is his legend has gone on for many decades through many different types of market cycles. And so in 66 to 82, when stocks were in a secular bear market because they had become too overvalued at the end of the 65 cycle, he had a difficult period in his investment company at that point. Then we got into the, 82 to 99 run where stocks basically went up in a very smooth, never-ending cycle. But then they got to this ferocious peak of historical highs in 2000 when valuations were crazy and prices were vastly overdone. And that really set us up for the last 18 years of very difficult market conditions where we've vacillated between these periods of extreme overvaluation to sudden waterfall losses that take markets back to, cut them in half and take people back many years and that sort of thing. So Buffett over the years has become, the fund itself is over $700 billion with enormously large positions in many of the stock holdings. It's a stock fund by its very nature. And so it's very difficult to move out of some of those positions without moving the market against oneself. So what he's really become is a closet indexer. And so, like I said, when stocks are going up, that looks great. When stocks have secular contractions, as they do cyclically throughout this period, Berkshire Hathaway shares lose half their value with the S&P 500. So my point would be, his legend is not warranted in this environment. It's certainly not that he's become a buy and hold investor in this climate. And it took all the way from the losses that the fund incurred in 2008 when it fell by half with the S&P. It took 5 or 6 years thereafter before it even made back those losses and then got into sort of net gain territory. So here we are back at the peak valuation period where, by Buffett's own favorite indicator, which he has long proclaimed, is the market capitalization of the U.S. market divided by the GDP. So it gives you a sense of what multiple people are paying for this idea of economic growth or revenue growth in the economy. How many, times that are they paying as a multiple in price? And when you look at that chart, which I put on the blog, courtesy of Jesse Felder, it shows this ratio that Buffett has proclaimed at different times to be the most reliable indicator of future returns that he's ever come across in his 60-plus year career. And unfortunately, we are right back, nearly as bad as we were at the all-time high in 2000 in terms of, paying some 130% total value of equities to the overall economy. And that means that they're heinously overvalued. They're more overvalued than they were in 2008 by quite a measure, and they are nearly as badly valued as they were at the top of the tech bubble, which everyone looked at as, mass craziness when we looked back at it after the bust. So here we have all this media scrum around Buffett in May, talking about, tell us, why you think stocks are going to outperform. And, of course, as the CEO of that company, his job is to reassure shareholders that they'll be able to find things that, will make them money. But, unfortunately, when you look at the correlation of future returns over the next decade, we're not talking about over just a year or two, but over a decade, following these periods of extreme overvaluation, what you find is that there is a decade of negative returns. And that has been borne out through many decades. Depending on the valuation level that you're putting the capital in is indicative or definitive of what return prospect you have thereafter. And from present levels, stocks are priced to lose money over the next decade, including dividends. So that means they're going to lose capital value very likely greater than whatever income they're paying to you. So this is a very serious prospect, because if you're putting your money into these instruments that have no set maturity date, which stocks do not, with no prescribed income flow, which stocks do not. They have dividends, but dividends can be skipped or reduced at the discretion of management. So you're putting your capital into these insanely long duration instruments in the hopes that you're going to get some kind of benefit out of taking on that risk. And the correlation suggests that there's just no benefit to doing that right now. Not only that, but as I was writing this week on the blog as well, Treasury yields have come up on the highest quality bonds in the past few months, to the point where treasuries, not so much in Canada, but nearly in Canada, in the U.S. Treasury yields are higher than in Canada, and you can make more in a 3-month government-issued Treasury bill today than you can by owning the S&P 500 stocks. So your duration of going out 3 months in a guaranteed instrument with a fixed maturity date and a guaranteed interest payment, you can have that in hand without taking on any of the risk of the stock market. And so that in itself is an indicator that sober heads begin to prevail when that happens, and I say money is being paid to come in the risk curve. Finally, after all these years of suppressing rates and paying savers next to nothing to try and entice them and force them into risk assets, which worked very well for in that purpose, central banks trying to push people out the risk curve. They did. They took the bait to the large extent, but now that stocks are priced at such ridiculous levels, they're going to have negative results for their risk exposure. It just makes no sense. So again, these are extremely late cycle indicators, and they suggest that it does not make sense to leave your principal in these instruments with all this risk and almost zero upside, in fact negative results likely.
Are Canadians allowed to buy American Treasury bills?
Oh, yes, you can buy U.S. Treasury bills, but you're exposed to the U.S. currency risk when you do that. So you have to also make a decision that you're comfortable with the currency movements, because if you think that the Canadian dollar is going to rise significantly against the U.S. dollar, that's another fluctuation that could erode whatever benefit you're going to get from the interest coupon. But the same can be said in Canada, where you can also buy Canadian treasuries or government bonds today, for a similar risk profile, or arguably less risk profile than a GIC, of which many people are familiar with, guaranteed instruments from the bank. In that case, your risk is the bank's credit risk. In the case of a treasury, you're looking at the government's credit risk. And in Canada today, you can get now about 3% for a 10-year instrument, and more than 2.3 for a 5-year instrument. The difference being that those bonds are actually liquid, so they can be bought and sold before the maturity date. So, the point is that there are other places that one can place capital for guaranteed returns in very dangerous market climates. And that is what we're seeing. We're seeing capital finally starting to leave these heinously overvalued assets and move into the least risk securities, which are the government bond issues at this point in the cycle. High yield debt, emerging markets, we're seeing money flowing out of there and going back towards these so-called safe havens, predominantly the U.S. dollar-based assets, currency, treasuries, and Canadian treasuries.
We'll have more with Danielle Park right after the break.
Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the U.S. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the U.S. and GET in Canada. Find out more at glancepay.com.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Welcome back. We're speaking with Danielle Park. Danielle, one of the stated purposes of the U.S. tax cuts was to give companies more money to reinvest in factories and hiring more workers. However, we saw a record buyback of stocks in the S&P, and that's what's happened with any tax savings. Was that a good move?
No, it was a terrible move. But you see, we have a very flawed structure right now. What we have is monopolies controlling pretty much every sector of the economy. And because of that, we have enormous excess capacity and underutilization of the workforce. They've made great efficiencies of scale in these large conglomerates, but competition has faltered. Small businesses have faltered. They've gobbled up competitors and put them out of business. And so you have, we're all kind of paying the price for that. In every sector that you look at, whether it's, phone, mobile, financial, drugs, food, whatever the sector. And so what we've got is these massive companies that are wielding insane amounts of capital into the political system, into the regulatory environment, and swaying rules in their favor. And so these tax cuts, there is no demand, there is insufficient demand in the economy because we've got so poor wage growth and poor multiplier effect of money moving through the economy. It's really being concentrated into these same pools with these same 2 or 3, motherships sucking everything up out of the general economy into these pots where it sits idle and has no real need, or we're way past, capital that would make sense for their business model. And so what happens is that it just sort of circulates and does nothing productive and goes back into financial assets and financial gimmicks, buying shares, buying other companies with shares, and really does great harm overall to capitalism, competitiveness, efficiency, productivity, all these things that ultimately are there to increase the standard of living of the broad population and economy. So this concentration is the problem, and it's everywhere you look, and it's in every country. And so the tax breaks, companies were already having record profit. There was no reason to think that there was a bind to there, that they needed to have more, cash flow to reinvest in their companies. There was no indication they were going to do that. In fact, Mnuchin was surprised when he was speaking about the Trump tax cuts coming in and asking audiences of business leaders, who here is going to invest in their companies. If you get this tax cut, very few of them had any plans to do that. That was all very clear before these tax breaks were brought in. But it's this the message that's driving policy today is very much driven by these mavens at the top who have infiltrated and swayed everything in their favor, and it makes the overall system much weaker. It's not capitalism. It's a fake system without competition, without positive incentives, with very perverse incentives, in fact, to the leaders of these companies, that is just, get the share price up, use every bit of cash you have to get the share price up. But as I've said, the problem with that is it's completely self-defeating, because if the share price becomes so gargantuan and obscene relative to the cash flows of the company, the growth prospects of the company, the efficiencies, the strength of the balance sheet, if it's all about just making a share look like it's more expensive, well, you get very expensive shares, all right, but then you typically get a decade plus after that where share prices plunge, where all that good money was thrown after bad, evaporates before your eyes, and people are left with nothing but the debt. And that's where they then turn to governments to say, hey, help us, save us, as they did last in 2008, and the taxpayer and the workers suffer even further in that period. So, it's just that the system has to be really, the idea of antitrust breaking up the large controlling entities back into parts. We've done this repeatedly throughout history. An excellent book on this topic if anyone's looking for, one is the book Move Fast and Break Things, which is about the tech industry. And it is, explaining why we have these, Facebooks of the world and Googles of the world, these conglomerates that are controlling the flow on all of our information, and all of the ad and profits and everything is going to this mothership, as I say, and not moving through and really being largely wasted, whether it be held offshore doing nothing, whether it be stockpiled in cash doing nothing, and then financialized back into markets which are not supposed to be there just for their own self-fulfilling gaming speculative activities. They're supposed to be there in support of the real economy, in support of job growth and, general improvement in the lot of the country.
We'll have more with Danielle Park right after this.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic Engineer gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, in Australia, a royal commission has found that financial institutions have been abusing their customers. What did they find, and is the same thing happening in Canada?
Yeah, shock of all shocks, Jim. Turns out that the financial sector in Australia has been also up to exactly the same playbook. As I've said many times, the leaders of these franchises all go to the same business schools, and they're all taught the same logic about how you scale, breach trust, take advantage of people who are not in the know, who come to you with their deposits or looking to you for advice. They see it as nothing but an opportunity to cross-sell every possible product in the world, whether that's in the best interests of the customers, the bank itself, the employers, long-term stability. None of that matters. It's all just get them into more products. And they've been doing this to such an insane level over the past decade. When it blew up in 2008, it was quite obvious then what had been going on, but because nothing was done to break up the cartels and everyone was sort of let go, given a pass, hardly anybody was prosecuted for anything, they just continued. And, speaking of Warren Buffett, one of his favorite banks that he has been an investor in for a long time is Wells Fargo. Wells Fargo has become a criminal franchise. It is in the news again this week with the next level of revelation about, fraudulent documentation, lying about people applying for things, pushing loans onto people they didn't ask for, cover-ups from the highest level down, all to goose earnings and make, so-called shareholder targets at the expense of the franchise and everybody involved in it. So we have the same thing, they've commissioned a royal investigation into, it's called AMP, which is a large financial services company in Australia and New Zealand, same as many of our big banks. It's the Australian exchange is in their top 50 index, AMP, and they were up to the exact same tricks. And it's very similar to what we saw with the CBC investigation that looked into that activity at Canadian banks over the last year, when they were finding that the employees were given, aggressive sales targets and driven like a dog team to try and meet them, regardless of whether or not it was good for their customers, or whether or not it was legal, whether or not it was, taking advantage of people's vulnerability in this area of finance. So it's classic. I think it's important that people, I find people are sort of in their own little world and not aware that this is such a big problem and that's costing us all so much, and that it's everywhere. It's like a contagion effect all around the world because of this model where, again, finance has been allowed to become conglomerates that run every possible type of product and then cross-sell and then are allowed to call themselves advisors take in deposits, speculate. In the States right now, we've got the Dodd-Frank rules being rolled back by the Trump administration, who's saying, banks can regulate themselves. I mean, we've had banks in their own words after every major collapse saying, we can't regulate ourselves. Greed does overcome the system. We do need healthy checks and balances. You guys have to have strong regulation. You have to force us to comply. Otherwise, we become monsters. And, whether it's John Mack of Morgan Stanley, who after the last crash admitted that in his testimony, or whether it's Chuck Prince of, saying you had to dance as long as the music was playing. And then when it blows up, they, come hat in hand to the government and say, you better bail us out or else. And, we just have to stop this insane cycle. And it doesn't take a lot. It just takes, trust busting from the Teddy Roosevelt idea of breaking up these conglomerates, keeping sales separate from advising, not letting people cross-sell their customers, disclosure, a whole bunch of things that would just be quite simple, and we've had in past eras. It's just been this past decade of everything coming together like a big mosh pit. These have become extremely out of control and in large degree criminal. And so it's a global problem.
Danielle, is it good news that the Canadian Pension Plan just announced that they had an 11.6% return last year?
Sure, it's great. The problem is a couple of things I was thinking about that. One, if you look at their decade-long return, it's 6%. Why is that, Jim? That's because they're long always and very exposed, and as rates have been low, they've taken on greater exposure to equity-based instruments, just like all the pension plans have, which is great on the way up, but it means that when you get a bear market, these funds, pensions, lose, 25, 30, 40%. Much more than would ever have been considered a prudent exposure to equities in past cycles has been taken on this time because rates have been low and government bonds, the safest assets, were paying a low yield. And so they've added leverage to magnify their returns, which it makes them much more risk exposed to capital loss cycles. And so, if they were able to make 11% a year, their 10-year return wouldn't be 6%. And this is at the peak of another cycle. So we have to be worried about what happens here when the next bear market inevitably presents, which is overdue, right? So when that happens, these funds, these pensions, are not reducing their risk today. They are like a Berkshire Hathaway. They are so big in these positions and so concentrated in many cases in illiquid instruments, because as I say, they've been pushed out the yield curve trying to make miracles in a low-rate environment. So they've been reaching for yield, buying things that are higher risk and illiquid. And what happens is when the crunch comes and everyone starts to raise cash and sell, they are likely to be holding things that fall a great deal in value and then take many years to recover thereafter. So if we're, celebrating at the peak of the cycle that we've made back some of the losses and that now we've had this 6% return over the past decade, we have to be aware that that means that we're going to give a good deal of that back in the next downturn, and that's going to lower the return prospects again. Meanwhile, the expectations for payments continue to go up, and the amount of people retiring and expecting to withdraw from the fund continue to go up, and the contribution level has not increased accordingly. And it'll be much more difficult to increase it during the next recession and bear market when everyone's scrambling to get cash and everyone feels like they're broke, and it's going to be difficult then to say, hey, the answer is we have to increase contributions and put in a whole bunch more money here to top up the pot.
Was the previous Canadian government right to raise the maximum pension age to 67 from 65?
Yes, I think they were. I think that the math suggests because we're living so much longer, because returns have been low, we have to get practical here. Because the demographics are what they are, we need to restructure these plans. Otherwise, they are not going to be there to provide the benefits that people are counting on. We have to be adults in the room and say, okay, math is math. How do we make this one work? And that means we have to look at, staggering out longer retirements, reflecting the fact that many of the people today will live well into their 80s, 90s, and to 100, much longer, 20 and 30 years longer than they were, 40 years ago, and that we probably have to change the indexing feature on many of these plans. That was a big, OMERS is now looking at reducing their indexing factor, that increases income each year in accordance with the cost of living. And the unions, of course, don't want this. I get that. But the problem is the funds just aren't there. And many of these pensions have had the exact same return experience. Because they're long always on risk, they go up with this cycle and then they collapse with the cycle, and then they take years to grow back the losses. Meanwhile, the withdrawals are accelerating every year. So this is why, these plans, these ideas, these economic and financial theories that have been perpetrated over the past couple of decades just don't work in real life. You really do have to look at what keeping the principal safe can produce, and then taking very limited controlled risk and increasing contributions, topping plans up when they're underperforming target, instead of kicking the can and hoping it all works out.
Danielle, thank you so much for chatting with us.
Thank you, Jim.
Have a great Victoria Day.
You too.
I guess the royal wedding is all part of the celebration, right?
I guess you either love it or you hate it.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet. You can also find us on the YouTube channel at Talk Digital Network. Any questions for Danielle or any other guest can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.